Evolve or Perish. Chapter 5. Corporation Income and the Stockholders. A corporation is an entity created by the state and endowed with powers to carry on certain clearly defined activities. The activities in which corporations are empowered to engage must be consistent with the welfare of the state and the people singly and collectively. Corporations are permitted to earn a profit on their operations. The profits, as well as all property held by a corporation, are owned by the holders of shares of its stock. The profits must be divided among the stockholders in proportion to the number of shares held. Corporation affairs are carried on by a board of directors operating through executives comprising management. In some corporations, the shares of stock are closely held by a small group, while in others, the shares are widely distributed. In some cases, the number of stockholders may be large, but a few persons may hold the bulk of the shares and in this way hold control of the corporation. In other cases, the shares may be so widely distributed and held in such small amounts that it is impractical for the shareholders to exert any influence on the directorate, and the management uses a free hand to run the corporation's affairs in any way that suits them. In such cases, the operations are likely to be carried on for the benefit of the management, with preference given to earning generous salaries for the management rather than dividends for stockholders. The stock of a corporation may be owned almost entirely by another corporation. There may be a chain of such corporation-owned corporations. Some corporations own outright several hundred other corporations. All of the earnings of subsidiary corporations go to the holding corporations. The chains of holding and subsidiary corporations comprise a large fraction of the total number of corporations. The subsidiary corporations are maintained for particular purposes that are not always consistent with the best interest of the community. They furnish opportunity for manipulations for the concealment or diversion of earnings and evasion of taxes. The extent to which these subsidiary corporations are maintained in continued existence with continual apparent losses is indicated by the number of corporations reporting no net income. Many of these corporations are loaded with costs by the holding corporations, which transfer to the holding company funds which might otherwise appear as net income, which would be subject to profits, or the funds are invested in plant extension or diverted in a multitude of other ways and for a multitude of purposes. The figures for corporations reporting no net income are significant largely as an indication of the complex corporation situation. Their losses appear elsewhere in other corporation statements as net income or are hidden away within the financial structure among the assets. Little confidence can be placed in the vast majority of corporation accountings. Some corporation statements conceal so much and tell so little about what is done with corporation funds and how income is handled that even the stock exchange has refused the listing of the stock of such corporations. The data on net and gross income of corporations as compiled from the reports of the Collector of Internal Revenue. The corporations which admit net income show substantial profits, averaging 8.2% for the whole decade. Calculated from the reported gross and net incomes, the profits in percent of gross income were: corporation profits 1920, 8.5%, 1921, 7.2%, 1922, 8.6%, 1923, 8.6%, 1924, 7.8%, 1925, 8.4%, 1926, 8.2%, 1927, 7.8%, 1928, 8.4%, 1929, 9.0%. This is a fair and more reasonable way of stating profits as a percentage of business done. Percentages of profit calculated on the basis of capitalization have no meaning. Such figures are usually much lower than the foregoing, and are useful in supporting the contention that corporations make very little profit. Those who receive income from dividends on shares of corporation stock so report that income in their income tax returns. Dividend income so reported in individual income reports returns is given in the following table. It is compared with the net income reported by corporations, showing enormous differences between the two figures. Figure 17. This tabulation shows that the corporations reporting a net income had a total net income during the 10-year period of $85,100,000,000. Of this amount, the stockholders received as dividends $34,600,000,000, leaving a balance of $50,500,000,000. Of these profits reported as net income, the directors voted 42% dispersed as dividends and retained 58%. If we subtract the deficits of $23,700,000,000 from the net income of $85,100,000,000, we have a final net income of $61,400,000,000. Stockholders received $34,600,000,000, leaving a balance of $26,800,000,000, which was withheld by the directors and used as capital for the purposes of the corporation. There is a subsidiary holding company relationship between a large percentage of the corporations which do not report a net income and those that do. There is reason for manifesting a large amount of doubt concerning the reality of the deficits reported by a great many corporations. A large proportion of gross income of corporations is expended for items which should come under the heading of expenditures from funds received from the sale of stocks, because they are capital expenditures and should not be taken from gross income as a charge against production. Vast amounts of money from gross income are used in amortizing bond issues, debentures, and such securities and paying interest on them. Funds received from bond issue sales are used for capital investment purposes, but such funds should be secured only through the sale of shares of stock. Surpluses, reserves, sinking funds, etc., should be set up out of capital funds and should not be created out of or increased from monies obtained as gross income from sales of goods or services. It is a routine matter of corporation accounting at the present time to divert monies from the gross income for the foregoing purposes and wrongfully charge them as legitimate costs against goods or services sold. If these charges were not made, our corporations would report enormously increased profits or net income. When such charges are made, they are concealed profits and undeclared dividends. There were 398,815 corporations in 1929, with a total capitalization of $109,800,000,000. The final net income, $11,600,000,000 net income minus a $2,900,000,000 deficit, reported by corporations in that year was $8,700,000,000, which is a return of 8% on investment. If all expenditures for capital purposes that were charged against goods and services sold were credited to profit or net income, the net return on investment would be many times 8%. Figures presented earlier in this chapter showed that during the 10-year period, the corporations withheld from dividends to stockholders $26,800,000,000 of the final net income, after subtracting reported deficits. This was from what was declared to be net income, and it was a small addition to the much larger amounts which were not labeled as profits, but which were plowed back into the corporation's capital structure in the form of bond issue payments, plant extensions, surplus, reserve, amortization payments, etc. Data is not available on these latter expenditures. Their total during the 10-year period would be stated in hundreds of billions of dollars. The New Deal imposed a sliding tax on declared net income of corporations not paid out as dividends to stockholders, but withheld for corporation purposes. A mighty howl was raised by those directly or indirectly interested in the financial affairs of corporations. It was claimed that this tax on profits was preventing business from expanding and was acting in general as a Pandora's box from which came every evil affecting the economic structure. This tax did not reach the very much larger amount of profit, which was never allowed to appear in the statement of net income. It is this diversion of gross income which is causing the major portion of our economic difficulties. Every penny of gross income, except, say, 6% placed aside for dividends, should be paid out for services and materials used in producing the goods or services sold. Or, conversely, only such charges should be made for goods or services sold as are required to cover the cost of goods or services used in production, plus a 6% dividend requirement. This is the fundamental basis of honest capitalism. Any artifice, method, technique, or system which permits a corporation to deviate from this principle and accumulate capital assets in excess of actual paid-in capital from the sale of stock is entirely unethical. It is collective economic embezzlement and differs in no way from stealing by one individual from another. At this point, our purpose has been to show that reported net income does not give any indication of the larger actual profits made by corporations. The diversion of gross income and the destructive effect of the practice will be discussed in a later chapter.